Welcome to Accounting with Our Bare Hands, a series of short videos on the mechanics of cost accounting. Today's topic is standard costing, the first of 5 podcasts on standard costing. The specific topic, isolating responsibility. So let's consider a very simple firm with two departments. Fabrication, which I'll indicate with an F, and assembly, which I'll indicate with an A. And fabrication makes parts for the rare left-handed stapler, and it transfers them to the assembly department, which puts them together. And we're going to think about 2 different possible costs to record this transfer. The first cost is how much the parts actually cost to fabricate. So that's the actual cost, and that's $230. But there's another cost that's useful to consider, which is the standard cost, how much it should have cost to make these parts according to the performance standards in the budget. And it should have cost $200 to make these parts. And so the question now is, how should we account for this transfer? Should we send the dollars along at what it actually cost to make the parts, $230, or what it should have cost to make the parts according to the budget, $200? Now, it may seem odd to use anything other than the actual cost, but what I want to convince you of in this short video is that using the standard cost instead of the actual cost is really very, very effective in isolating responsibility for what in this case is a cost to overrun. Let's look at the entries using our old friend, the Queen's Cross. As usual, I will use most of the space for the assets on the top left. And we'll just assume that, that the fabrication department spent a good deal of cash. It could have been on any number of resources to make their parts. And so we're going to make a credit to cash for $230, the amount that was actually spent to make the parts. Now, where is that going to go? The first place we're going to put that is in the work in process account for the fabrication department. So they spent $230 and they ended up with an asset, some parts that they fabricated for $230. And now what we're going to do is record the transfer of those parts to the assembly department. So what we'll be doing is sending that money from work in process fabricating to work in process assembly. And let's assume that we do what seems most natural, which is to use the actual cost of fabrication. We are going to credit the fabricating work in process for $230, and we're going to put that into work in process for the assembly department. And that sure seems like a very straightforward way of doing things. We have tracked the flow of our costs accurately because we spent $230 and effectively converted that asset, cash, into another asset, work in process in the assembly department. But think about this from a managerial perspective. If you are the manager of the of the fabrication department, do you care that you spent $30 more than you were supposed to? Because recall, our standard cost was $200. Well, it's no problem for you because you simply transferred that $230 onto the other department. Now it's the assembly department manager's problem. That's probably not a good thing. So let's consider, and here, by the way, I will label this normal costing because that is what this method is. Normal costing measures inputs at their actual prices and quantities. Let's consider a version of standard costing instead. We will create our Queen's Cross. Again, most of the action will be in the assets. We will start by crediting cash for $230. And where does that money go? As before, we can put that into the work in process account in the fabricating department. Okay? And here's where the change is going to come in. Instead of taking that $230 and transferring the actual cost, what it should have cost, plus the $30 of cost overrun, we're only going to transfer the standard cost. We're going to credit, we're going to have to credit this for $230 because the fabricating department no longer has their the parts that they made, so we'd better get this account zero to reflect that our left-handed stapler parts are no longer in this account. But we're not going to let fabricating transfer all $230 into assembly. We're only going to let them transfer $200 into assembly, what it should have cost. Now, we have a problem because we've credited our fabricating work in process account $230, we've debited the assembly work in process account $200. We are going to need another $30 of debit to make this entry balance. Where are we going to put that? We're going to put this on the income statement. And this is what's going to be called a variance account, in the sense that it's a deviation from the performance standards in the budget, and we're going to label it with an F, okay? Because this is the fabrication department's variance reflecting their cost overrun. They spent $30 more than they should have. Okay, now now that our debits and credits are all in balance, we can talk about why we did it this way and how it helps. Well, it really helps in a number of ways. The first thing to note is that fabrication no longer has the opportunity to simply transfer their cost overrun to assembly. They've only transferred the $200 it should have cost to make the parts. The remainder shows up on the income statement with the fabricating department's name on it. Now, this is a debit, so what we have over here are expenses and losses. That's the lower left part of the Queen's Cross. So this is either an expense or a loss. The one thing it definitely isn't is it's not an asset, and that's a good thing. Okay, what we're saying when we use standard costing is that if we spend too much to produce something, we haven't increased our assets, we've actually lost money. We have a variance, right? This is a reduction in our wealth. You can think of it as an ongoing reduction in our wealth, something that's central to our production process, which would make it an expense. You can think of it as a one-time surprise, which would be a loss. But either way, it is reducing your income. It is also a wonderful attention-getting device because everyone notices items that reduce income. This is reducing income immediately by $30. People are going to discuss that. They're going to want to know who's responsible. I'll tell you who's responsible. Fabricating. They can no longer pass their $30 on to assembly. We are not pretending that $30 is an asset. Okay, and we have done what is called isolate responsibility. We have isolated the responsibility for this overrun with fabrication. excuse me. We can improve on this standard costing method a little bit just by recognizing this $30 variance, this $30 reduction in wealth more rapidly. So let's start over, and we're going to do almost exactly the same thing. We have spent our $230, but now when it comes time to put that $230 into our fabricating work in process, we can say, whoa, hold on. We already know that this $230 is $30 more than the performance standard said it should be. So let's only debit $200 to work in process, and we will recognize our variance for the fabricating department right away as an expense. We're not even going to wait for the transfer to the next department. And this is the type of standard costing that we're going to be looking at in these videos, which is preferable to the version we saw a minute ago because it gives us our variance information as soon as possible. Okay? So again, one of the primary goals of standard costing is to isolate responsibility, to identify cost overruns and underruns immediately and capture them not on the balance sheet, but on the income statement, where everyone will notice them and where we are not claiming that cost overruns are assets. And by the way, cost underruns won't be treated as liabilities, because think about, or reduction in asset. What if we had only spent 170? Well, actually, right, we would have made money if another time we do this for 170, and this is, we're still going to put 200 in here, but now we're going to have a $30 credit. Okay, and I'll put little stars by these numbers so you can see that that entry all goes together. Thanks a lot. I hope you found this helpful, and stick around for standard costing videos 2 through 5. Bye-bye.